Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He writes for the Financial Intelligence Report. He's talking to us from the beautiful Bahamas. Welcome back to the show, David.
Yeah. It's good to be here.
David, the NASDAQ setting record highs almost every day. The S&P almost back to the same level it was before the crash. What's going on with these markets?
Well, there's a couple things. First of all, what we have to look at is the dynamics. Let's look at the macro kind of economy or these companies. Remember, a lot of the people who have benefited from COVID in terms of corporate world are these large companies, right? Because they didn't make Walmart. They made the mom and pop store shut down. And by the way, morally, I think this is really reprehensible and disgusting what the governments have done in this regard. But you could go to Walmart or you could go to Costco or these big stores, right, to do your grocery shopping and et cetera. So then a lot of these mom and pop stores won't be able to survive. So that means more market share, or you're ordering things off Amazon, et cetera. And I did that. Even in the Bahamas, we have services where you can order. You have a forwarding address in Florida, and they fly it over here. So it's like when I couldn't do anything, you're sitting around your house. I was like, I'm going to order some stuff off Amazon, right? So these companies all benefited from that. And actually, like something like the top 6 companies in the S&P and in the NASDAQ make up a bigger percentage of the index than they ever have. And the last time this really happened was in the 2000 .com bubble. Back then it was like Cisco, Oracle, Microsoft, et cetera. Now it's like Apple, Amazon, Microsoft actually again, in these kind of companies. So you have that factor where these big companies did actually benefit because now they're going to increase market share, their sales held up during it, et cetera. So that's the first factor. The second factor is they gave everyone these hyperinflated unemployment benefits, on top of the $1,200 in the States and the $2,000 per person in Canada. They also, the states and federal government kicked in with a little extra on your unemployment, extended the benefits, did some tax credits, et cetera. So in a lot of states, they're saying that people were made more money the last few months, than they were working, or at least, roughly the same, or maybe even just a little bit below. And with this kind of like disposable income, because these people, aren't working and are locked in, I think a lot of them turn to the stock market. And then the stats have shown it. Little apps like Robinhood and other discount traders have seen a huge amount of new accounts and new traders come in. And these people really don't know anything about the market and the momentum chasing. Like Tesla is over $1,000 today. There's a company called Nikolai. Hey, if you're gonna name another electric car company, you might as well name Nikolai if you already have one called Tesla, right? And that company, they just came out with a prototype for their own electric truck, and they're taking deposits on it. And that stock now has a bigger market cap than Ford, which is ridiculous. And so I think you're seeing this kind of mania play out, combined, because people are sitting around doing nothing. And then, of course, the Fed pumped all this liquidity into the market, and these few companies, like I said, have benefited, and there's a lot of momentum traders going to those as well. So you have all these different aspects. And it's, in the end, it's probably liquidity driven, along with all these kind of amateurish investors who really don't know what they're doing. And I think it's going to be very dangerous because one of the key indicators I watch is market cap to GDP. So you take the market cap, on the stock market divided by the GDP. They call it the Buffett indicator because it's Warren Buffett's favorite indicator. And if you factor in the fact that GDP is probably going to decline, at an annualized rate like 40%, but like at least in the quarter 10%, in the second quarter here, we're talking the market. The market's basically back at the highs, but the GDP shrunk 10 to 15% in the first 2 quarters. So the market now, as compared to the economy, is more expensive now than it was in January. And the last thing I'd like to say about this mania and these stocks going crazy, a lot of these bankrupt companies too have had huge rallies. And like I said, these momentum traders chasing it. I think it's the craziest market I've ever seen. The fourth quarter last year, we saw a lot of retail investors go in. We saw the start of this kind of parabolic move. And then, of course, in 99, 2000, I'm old enough to remember that as well. And, but I think what makes this the craziest market is that you've got protests and riots in the United States. You got COVID going on. You got mass unemployment. And yet we have the stock market going to the moon.
With the central banks around the planet cranking all this money into the stock markets, what happens when that money stream stops?
Well, I think the thing is, it's like also the rate of change in terms of the money printing. So I think one thing is we saw the initial big surge. Like I just wrote an article for a financial intelligence report, which I write for, about corporate debt. And what's interesting is usually when you have a debt bubble, companies issue less debt, when there's a downturn, because they're like, oh, we're too leveraged. We got to pay off that debt. We got to stop doing it. And it seems to me what's happened now is the Fed just basically set up a fund where they could borrow from. And there was something like $750 billion, loaned from the Fed in the investment grade corporate market in the, in the March, April, May period, while the COVID kind of took hold. So it seems to me what's kind of happened is these corporations have leveraged up even more. And I think the idea is almost a hope thing where they can borrow that 750 at almost zero rates and then be like, oh, and then we're cashed up, because, that just goes to cash in your balance sheet once you borrow it. And we'll just use that to kind of, outlive this downturn. And then, and then when everything comes back again, we'll pay down that debt. But I think that's going to be a false narrative, because if there is a W recovery or a slow recovery or not much is going on in the economy, they're not going to be able to fund these high debt levels, even at low interest rates. Perfect example, and this is not a company, this is a country, but Japan, even though Japan has near zero interest rates, because their debt level is so high at 250% of GDP, they still spend like 15% of their revenues on interest payments, because that's the issue. When you start getting into that debt level, it's like if you in your personal life, even if you could borrow $4 million and buy a $4 million house with that at 1% interest, you're still going to be paying, $40,000 in interest a year. And if you're somebody only making, say, I don't know, $80,000, that's 50% of your income. So I just think that this is a flawed liquidity trap that's happening right now, and it's causing this almost manic move in the stock market. And it's not just that; it's part of the psychology. Is I think a lot of people just think, once COVID ends or dies down, everything's gonna be normal again, and then that's the stock market is anticipating that. But I always, regardless of what you think is politics, I don't believe in efficient market theory, which says the market's always right. I believe actually what George Soros talks about reflexivity, where the market always overshoots to the upside, overshoots to the downside, and the market is always wrong, and then has to reflex, has to go to the other direction. And I think that's what we're seeing here in the stock market, that it's reflexing way too hard and strong on this liquidity that's being added.
We'll have more with David Skarica right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with David Skarica. David, the U.S. Fed says it's going to continue its emergency powers to keep pumping cash out. What's that going to do to the markets? Is this mania going to continue?
Well, in terms of here's my opinion is that I think at some point this all stops working. If you go look at 2008, we think about the Fed and the government bailing out the banks and doing QE and doing a stimulus. But remember, from 07 to 09, the market fell 60% before that happened. And by the way, in both 2000 and 2007, after the initial drop, this initial drop was a lot steeper, but there were sharp drops in April of 2000, in August of 2007. There was a secondary top, which happened in October of 2007, and August of 2000. So I think we're seeing that kind of rally right now. And then at some point, I do think the fundamentals and the realization that we're not going to see these emergency kind of powers work by the government, and we're going to see at best a W recovery and more likely an L-shaped recovery due to the changing nature of the economy right now. And when that happens, the market is going to have to reflect that and go down. Now, the only way the market can still zoom up is if we get some form of hyperinflation. And of course, then it won't even matter because, it's like Venezuela's stock market has been booming. What does it matter there, right? So I think that would be the only way I could really be wrong. But I think also you have to look at the backdrop of everything going on. And of course, when you see these protests and what's going on in the United States, politically, I don't really want to get involved, but in terms of, what you think or whatnot. But if I look at an economic standpoint, who would want to invest in these communities? Who would want to invest in a lot of these cities? And who would want to invest actually a lot in the United States right now? When you look at, Asia, you look at the places that still are going to have longer term growth. And I think even though there's dynamics, obviously they always support the dollar because it is the global reserve currency. I think at some point, especially if they start going towards universal basic income and all kinds of other projects to kind of appease what's going on politically, that hurts the dollar even more going down. Of course, that's great for gold as well. So if you get the combination of that, more government spending, probably move towards more socialistic policies, and kind of this maybe what's going on in the States, this kind of uncertainty. And then the market realizing that this recovery is not for real. I think the scenario is set up perfectly for gold to really move in the second half of this year and into next year.
We'll talk more about gold and oil when we return with David Skarica.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with David Skarica. David, gold and silver a little flat right now, not a lot of action, but do you expect it to pick up later in the year?
I really think this kind of rollover, which I expect in the stock market, will be a key factor in that. Because then there'll be one thing that we really haven't seen, and it did happen a little bit in 01, 02, but we haven't seen for a while, is in these markets. It's one thing that we haven't seen is gold trade counter the stock market. Really in the 2000s, we saw from 02 to 07, gold moved with the market, then crashed with the market, and then we saw gold crash with the market and kind of that liquidity-driven decline in March of this year. And gold has rallied with the market here. But I think we're going to start playing disconnect, like it should be. Like that's what happened in the 70s, where and the market starts falling over, the economy's bad. And especially if this is kind of coincided with issues in the dollar, issues and kind of people looking at what's going on in the U.S. and saying, hey, they're not really the stable superpower anymore because of everything's going on there politically. I think that is when you see this kind of flight to gold, and gold actually do well while the market goes higher. And of course, I actually like silver even better because once we get from this deflationary kind of bust in the economy to reinflation or inflation, silver will start to outperform, and the gold to silver ratio, even though it's not at the extreme that it was, back in March, it's still very high, which means that silver is very cheap historically. So I really like those things. And oil is really interesting because, short term, I don't know, at 40, I think we're pretty fair valued here, especially with a weaker global economy. But the funny story I got to tell you is, I had a friend of mine who used to live in the Bahamas, Canadian guy. He was a stockbroker, and he hasn't been a broker for years. I don't think for about 8 years. He wrote me the day that oil had that. Remember when it went negative, right? And was talking all about like shorting oil companies and shorting banks with exposure to the oil companies, and he thought he was I don't know like one of the guys in The Big Short or something. And that was a total contrarian bottom signal. I actually bought a couple oil stocks that day. So it's just kind of funny the way these things work out. And, there still is a little too much supply in the oil market. The global economy is still weak. So right now, I think with oil, we've probably seen this nice move off the bottom. Technical oil never really got negative. That was just that one day and that one contract. Really the low, if you look at it, was like between 10 and 15. So I think that we've had this nice move off the lows, and we'll probably consolidate here. And if there is this decline in the stock market and it hits oil and oil stocks one last time, I'm going to be really bullish on the oil stocks. Probably, I'm thinking that happens in the fourth quarter of this year. I'm going to be I'll probably actually be rotating money. If I'm correct and gold catches a bid and oil sells off, I might be rotating a little bit of money out of gold, say at like 2,000, and into oil at 20.
Starbucks says it lost over $3 billion in the last quarter. It's closing 200 stores just in Canada. Is this the future of retail food services?
I think that you have to look at, I really believe that we've changed the whole structure of the economy now, right? And I'm not even talking about if they start doing universal basic income and things that are going to cost taxpayers and squeeze taxpayers even more. I'm just talking about from the standpoint psychologically of people seeing that market decline, people losing their jobs that quickly, people wanting to be more frugal. I really think this is going to be like the 1930s here, going forward, and it might take a year or two for that realization to really start. But Starbucks to me is the kind of business model that is a total failure in this kind of new economy, if you want to call it, where people are looking to be frugal. People aren't going to pay $6 for a latte, all of that sort of thing. And I think their business model is a real failure. Like most people in that kind of being more frugal will start making their own coffee. But if they do, we're Canadian. What's going to happen? Someone's going to go to Tim Hortons instead of Starbucks. In the States, someone's going to go to Dunkin' Donuts, right? So it's like that kind of business model, I think, is a real failure. And to me, Starbucks is a great short because I just don't see people paying $5, $6 for coffees in this kind of new frugal economy that we're entering right now. And I think like another short I like is CarMax, KMX. They sell cars. They have a bunch of lots all over the States and et cetera. And again, because I think that subprime auto loan boom and people buying cars that they probably can't afford, again, in this kind of new economy where people are being more frugal, that's again another failed business model. So if you're looking at stuff outside of gold and precious metals or outside of like kind of fear trades, like stuff that could catch a bid because everything is weak, I think you want to look at stuff that's going to, it's either a new technology that's not dependent on the macro economy, or you're going to look for business models that maybe benefit from frugality, like that sort of thing. And the problem is, though, on the flip side, you got to make sure the stock is cheap. Like Walmart would actually be a good company for the new era of frugality, especially because they're going to take over even more of these mom and pop shops failing. But the problem is Walmart stock is not cheap, so I wouldn't be chasing it here. But I definitely think that Starbucks, that's a classic example to me of a business model that was totally set up for the old economy when people had disposable income, yuppies were able to throw money away. And in this kind of new phase of the economy we're entering, that is a disaster. And if they rebrand the whole company and start cutting prices on stuff just to remain competitive, well, that's going to kill their margins. So that's almost as bad as closing stores anyhow.
David, thank you so much for chatting with us.
Oh, thanks for having me.
My guest has been David Skarica, founder of the Addicted to Profits newsletter, online at addictedtoprofits.net. If you have any questions for David or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.